Okay, but in the meantime, I will pull up this table and share my screen.
Trouble is, I don't think a minute is enough.
But right now it feels like 10, right? That I sent it
Sometimes you
about
need
45
a
seconds ago. Okay, it's left my outbox, so you guys should have it in a second. I built it last night off of what we used before, so hopefully it's, I haven't
Came in.
found any errors, so hopefully it actually works, but it'll be good to walk through it. Okay, it should be hitting your email.
It's hit.
I got it.
Great.
Chris, are you on? Because it's still asking, it's still saying when I try to hit the record button that I need permission from the host.
It's recording.
It is recording.
Yeah,
Oh,
it
it's
says
recording.
it's recording now.
Okay, we're good. Thank you.
Okay. So we'll pull through this sample table. Can you guys see that?
Yep.
Okay, so this is actually where most of the, it doesn't look like a cap table, but it's where most of the action happens. If you're doing, this is all assuming, like, call it series seed, A, B, C, whatever, I think I call it seed, a venture priced financing round. So your pre-seed table might look really basic like this, right? You've got a couple of founders that have shares, maybe you've issued some options or some shares from the option pool. Usually there's no one else. This isn't that much different if you have additional investors, because the important part of having this tab is understanding your pre-money inputs, right? So if you have a series seed, the whole way the valuation works is dividing by the existing capitalization before the money comes in. For purposes of this this fake series seed, I've assumed we have one pre-money cap safe and one post-money cap safe. And we'll talk about what those mean, because the post-money safe originated about 2 years ago now, fall of 2018, I think. Still not super widely used, but coming up, I just did a financing Allian I did, where they had both pre-money notes and a post-money safe. Definitely required some attention to detail for the financing. Okay, so when you get a pricing, a term sheet, for instance, right? And actually, this is a really good exercise if you work with founders, right? Because the investors don't really care. The investors care about, if you're on the investment side, having a, what we call fully baked pre-money valuation. That means that any possible shares that could be issued to people before the investor's money goes in are considered as part of the pre-money pool. So not just founder shares, but the option pool, any option pool increase, any, and more, this is really important to see in this cell right here, in cell D18, the fully diluted share count for, like if Morpheus is doing an investment, for instance. We make sure it, including the term sheet, it's fully, we say it's, you know, it includes all shares issuable upon convertible notes, etc. 10 years ago, you might have seen a big negotiation over whether or not shares under a note should be part of the pre-money or part of the post-money, like treated like additional funds coming in or considered like their own prior round. So most priced rounds these days consider shares underlying convertible notes or safes to be part of the pre-money, as in almost like their own mini round before the new money comes in. So as an investor, that's what you worry about. You say, I'm putting in this fictional example here, and I have these yellow cells. The yellow cells are the ones to input numbers. Everything else is either a formula or linked to to the pre-money tab. So these numbers come from a term sheet, right? 8 million pre-money valuation. The amount of new money is 3 million in this case. So in that case, the investor should own 3 divided by 11, or about 27%, I think. Yeah, so 8 million pre plus 3 million new money, they should own 27%. They don't really care. I mean, they care as far as making sure founders are incentivized, which is why you see a lot of recaps around the seed to A stage. But on the investor side, you don't so much care about the mechanics underlying this, other than that at the end of the day, you have your ownership percentage. And of course, making sure they're done correctly, because you don't want to have people coming back later and saying that you didn't calculate correctly their ownership under the safe or something. But this is really, really important, all these modeling activities for founders or early stage holders of a company. On your company side, one of the best things you can do for a company raising a note or a safe, for instance, is to come up with a mock priced round and see what it looks like. Say, okay, if you raise a note on, you know, some companies do like 4 note rounds now. It's very cheap and easy, and there are some articles around why That's dangerous. They're not inherently bad, but they're bad if you don't know what they look like, what they mean for dilution, because no one actually knows unless you actually model out what happens when the note or the safe converts. What do the founders own after the financing? You know, what does having a 500K note with the $5 million cap actually mean for the founders or for the option pool or for seed investors? So actually, a lot of times I do this modeling for people who are raising notes and safes. They're not even doing a priced round. We just make up a round to say, just get a sense of, are these note and safe terms reasonable? Are we going to end up diluting ourselves more than is acceptable, for instance? But definitely time to do these when you have a priced round. So going back to the pre-seed table here, we're assuming a post-money safe, a pre-money safe. The activities for pricing these out are the same if you have like 10 safe holders, if they all have the same terms. You can just use the aggregate holding amount, you know, aggregate of 300K or 3 million, it could be anything. So it's all done based on groups. So a group of safes at, this one is 4 million pre-money cap, 10% discount, and 300K outstanding. And again, if we had like 10 holders under there, it'd be the same price. We just figure out the pricing based on the aggregate amount and then break it down by holder afterwards. Any questions so far? Does that all make sense? Okay. So this does not look like a cap table, right? This is actually just what we call a worksheet. What you'd actually do after this, and I haven't gone this extra step because it's not really, it's just translating numbers into rows. But what you would do after this is make a new tab called the post-closing pro forma, right? And that would look something like down here, the summary. And you could break it out by holder, right? So you'd have something that looks like the pre-seed cap table, but you'd add additional rows for seed between founders and incentive plan. I haven't gone to that effort here because again, the key for the math is all in the worksheet numbers. Once you get the price per share and for each individual group and how much money they're investing, the only exercise from the worksheet to the pro forma table is just translating based on your breaking out by holder. And you might have some breakage, by the way. You know, rounding functions are really, really important. If you don't know how to do a rounding function, take a look at what the inputs to these cells are here. Like, for instance, here in B32, use the rounding functions. If you do not, what happens is Excel displays a price. They might say display out to 4 digits, but unless you have rounded, Excel is calculating that based on an infinite number of digits. That might not seem like it matters, but it does when you end up with a certain number of share counts that are off by 5, and you wonder why someone got a few more shares than they paid for, and why the table is not lining up. So for purposes of things like opinions and making sure shares are fully paid, always use rounding functions when you're doing a table. Okay, so the important part is to start with assumptions. This is called, just up here we have pre-series seed. These are all tied in this case back to the pre-seed cap table tab. They're just linked back there. Total common stock held by founders. It's important to net out any shares. In this case, for instance, we have 100,000 shares issued from the stock incentive plan. Maybe they were stock purchase rights, maybe they were an option that was exercised. In any case, they're outstanding common shares, but we do not want to count them here because they're being counted as part of the plan. So they're netted out here. And also, by the way, I should say, this is how I do it. This is all addition and algebra. There are probably 4 different ways to get to the same conclusion, right? So if you have a way that works for you, as long as the end goal works also, that's fine. You could, for instance, net them out from the option plan, right? So the important thing is make sure nothing's getting double counted and to make sure that everything adds up. And you can do things by checking, for instance, at the end that, like I said, 3 out of 8 for the new money should be 27%. So you go down here and see, sure enough, they're 27% based on everything working out. So check a few numbers through it. This is not the only way to do it. It's the way that I like to do it. And it's the way that a lot of other firms do their form cap tables. Okay. These are all just inputs from the pre-money table. They're just assumptions. They can be whatever actuality reflects. So if we had, it doesn't really matter if we have 10 million or 200,000. The important part is just getting them accurate. And then we get into the fun stuff, which is there an option pool increase? What is it? And is there You know, how are the safes calculated, for instance? Are they pre-money, are they post-money? By the way, same mechanics apply here for convertible notes, except for you'd have an interest component. I don't have that here. If you don't know how to calculate interest, ask me and I will show you how to do it. That's relatively straightforward. It would be the same math as far as safes versus notes. I just said safes here to keep it more simplistic. Okay. Promised options. There is a concept. Let me just actually take a detour into does everyone know what a post-money safe and a pre-money safe is? I'm guessing some of the junior associates might not be familiar with that.
Describe it.
Okay, I'm going to do that and speak up if it's too elementary. Traditionally, our form note, most people's form notes, even Y Combinator's original safes, were what we call pre-money caps. So when you do a venture financing, you have a pre-money valuation. Contrary to popular opinion, a cap and a note is not the same as a valuation, but it implies what valuation would be applied. So a note with a $5 million pre-money cap means that even if when your triggering financing round comes around, it has a $10 million valuation, you as a note holder pay only $5 million. Pay a valuation, whatever the price per share is implied by a $5 million valuation. And typically that was set up to use the same base denominator. You have, in that case, you'd have a $5 million pre-money cap divided by whatever shares were outstanding before the financing. Plus, in most cases, whatever increase the option pool was happening. So that means if you have, for instance, between 7 to 15% is pretty typical for an option pool target. Here we've put 7, it could be anything, just an input number, a plug. Okay, so if you have in the CELIC, in a pre-money cap note or a safe, and actually if you go to the YC site, by the way, they no longer have their pre-money safes. So if you need to do a pre-money safe, you have to either modify the post-money safe they have or go back and find an earlier version of it. And if you do modify the post-money safe that's currently on YC, make sure you also take out the statement that says every party acknowledges they haven't modified this document other than to plug in the numbers. So it's really set up the new version to just be plug and play and not allow for modification, but there is no pre-money safe sort of out there on the YC site, but the old one's still, it's probably still somewhere on our system with different companies. Okay, so look carefully at the inputs. And these all, by the way, these right here are all the denominators, right? So this is what the question is, what cap are you using, right? For the notes or the safes, or for the new money, what pre-money valuation? And then to get a price, you divide that valuation or that valuation cap by the total number of shares assumed to be outstanding before that pricing gets applied. And in this case, you'll see they're all different, right? That's because, like I said, the price rounds these days are usually fully baked. So that means that this number for, actually, can you guys see when I'm highlighting cells?
Yes.
Yeah, okay. This number for the new money denominator includes all the shares issuable upon the safes, which is why it's higher. The reason these two are different is because they have different inputs based on their terms. And by the way, you could have any combination of these. You have all these numbers here. You have, you know, common stock these are always going to be included. Common stock outstanding, warrants, option pool. Then you get into the fun stuff of, is there an option pool increase? Are there promised options that haven't been accounted for? Things like that. So always pay attention to what the math of the convertible instrument says. This will be in the conversion section. It'll say something like, this safe will convert, you know, at a price equal to the conversion price, where the conversion price is the lesser of the discount rate, right? Which is, we can talk about in a second, or the cap divided by fully diluted capitalization. And then you have to check the fully diluted capitalization definition to make sure that you pull in all of the variables that the safe or note says should be pulled in. In the YC safe post-money cap, for instance, it includes not only the existing common stock and the option pool, it does not include any option pool increase in most cases, which is different from what we're used to seeing in older pre-money safes or pre-money notes. And the reason for that is it's meant to really be a post-money safe. They're saying, look, we're not going to pull in the option pool increase for the new round. It's meant to be a standalone mini round. That's why we have this post-money concept. And what it does is it pulls in all the shares issuable upon other convertible instruments, including that safe itself. So if I hold a 500K safe, a post-money safe, that has a 5.5 million post-money cap, with no option pool increase and no other convertibles, that's the same as a pre-money cap of 5 million, because the 5.5 includes the 500 coming in from my safe. So importantly, this number right here for any post-money safes includes not just all the stuff up here, but also the shares issuable upon the conversion instruments, including the one itself. Just like if you're talking about a Series A financing with a $10 million pre-money, like in this one, for instance, a seed with an $8 million pre-money and new money of $3 million, that should be all else equal the same as an 11 million post, right? So that's why post-money includes the amount of the safe itself. And this gets to another really, really, really important point, which is when you are doing things like this, or even if you're reviewing tables from other parties, don't forget to open and make sure iterative calculations are on. That is File, Options, Formulas, enable iterative calculations. If you do not have this, and when you update things, this allows you to have that circular reference error that shows up in Excel if you have a cell refer to its own input. This says, ignore the fact that this is circular, just run a bunch of iterations to get close to the right answer down to a fraction of a unit. So if that's not checked and you make changes and there are circular calculations, you'll just get an error and you won't actually get the correct answer. Or worse, you might not throw an error if you have circular calculations turned off as error throwing, but you just won't have the correct number. So if something's not adding up, double check that. Unfortunately, this does not seem to save and follow the file when you send it. For instance, if we send, I think Ali and I had this with the one I talked about with the two different safes recently. We sent it across to Wilson, and they said it's not working for some reason. We had to tell them to turn on iterative calculations. So it should be something that an ABC lawyer looking at should know to check. Otherwise, this will not work. Okay. Let's see. So let's just go through the different variables. Promised options. This is something new in the post-money safe concept. Again, it does not include any option pool increase. But the drafters of the safe thought it was fair to say, well, that makes sense. We're treating it as a mini round. But if the company has promised 100,000 or 500,000 or 1 million options to people through offer letters that it just hasn't granted yet, the fact that it hasn't, the fact that it's promised doesn't already committed them should treat them as allocated. Just the same way that you would say when you're looking at an available option pool, that would actually be truly available, not already allocated, even if not yet granted. So that's meant to capture available pool for future expansion. So promised options means options that you have, in this case it's 0, but let's say it was like, 1 million, then you would show that you had a shortfall in the pool being available pre-increase. Right, then you have to have, then this promised options in excess, that 150K gets added to the post-money or to the pre-money here input. So just, watch out for that as far as and this should be an input too for pre-money safes, frankly. I haven't done that here, but you'll see that crop up in disclosure schedules. If the investor sees the company's promised 500,000 option grants, they're not going to count those as part of the available pool because they're not truly available. Okay. And this is all really at its heart. You'll see in the formula is just algebra. So think back to like 9th grade or whatever year you had algebra, and think about just the different inputs and what, A, B over C, whatever. It's really just, it can be overwhelming to write out the formulas, and hopefully we can use something like this to just be a more or less plug and play going forward for financings that we have. And you can all use this to modify as needed for future financings. But if you want to understand where it's coming from, just think about what are the algebraic inputs. And so we'll go down here. You can do these in any order, really. I did the seed, the new money first, but they all, because they are interrelated and they all go into each other's pre-money calculations, you can do them in any order. So in this case, we have, and again, the yellow cells are just numbers you can change. They're just numbers that I picked out of a hat. This number here, fully diluted shares before the new money comes in, that's a pretty easy pricing calculation. You get the 8 million valuation divided by shares before the financing to yield a price of 65 cents in this case. More complicated, going down here, you have the pre-money cap safe, but similar analysis, right? It's still just at its heart, whatever the valuation number is divided by the share count. So it'd be 4 million divided by the applicable share count up here, 10,334,538. But we have a complication here, which is a discount. So as you are hopefully familiar with, but if you haven't done this in your junior, you might not have seen yet, when you have caps and discounts, the investor gets usually, not always, but 99.9% of the time, the investor gets whichever is more favorable, not both. So that means the investor pays the minimum. So in this case, you can use a minimum function. Minimum of this part right here is the valuation divided by share count. This part right here is the discount factor times the price paid by the new money. So whichever is less, they will pay that price. So use a minimum function for that and a rounding function. Same thing applies here. It's the exact same analysis for the post-money safe. It's just the only difference is the input for what the denominator is. When you're dividing that valuation, you're looking at cell 17, there'll be 17 instead of 16 to make sure you're capturing all of those pre-money inputs as far as the other convertible instruments in this case, but not including the option pool increase. So ultimately the math is really, really similar, but you're looking just at what the inputs are. Okay, and that's actually really the heart of, once you have the pricing, everything else is really easy. All you do is, take the amount invested divided by the price and round down. So, and this round down, by the way, is much more important when you're looking at individual shareholders. If I'm investing 4 million, or if I'm investing 300K as a new investor, my share count gets rounded down because that's important for making sure shares are fully paid. And then you can just break that out by, say this consisted, for instance, of instead of one 300K safe, you had one of 100K and one of 200K, then you would just break this out and you do a new tab saying, okay, the price for the safe, for the pre-money safe is 3871. So we'll do 200K divided by 3871. There's Caroline's share count. Maybe Scott had a 100K note or safe. So he's got 100K divided by 3871. There's Scott's share count. And you just input each row. So that's really just, plug and play with the dollar amount and price. And then go ahead and check these things. The option pool, for instance, if we targeted 7%, this should be 7%, which it is. New money should be 3 million out of 11 million, which it is. That's 27%. So just, you can go through and check these things, for instance. There's that same, so if you just make sure that's 7% of the post money. Yeah. Okay. So any
Caroline,
questions on the pricing exercise?
No, I mean, I have no questions, but I think the key thing that for me, the takeaway that this illustrates is the convertible securities are certainly better off than investing at the current money, but they're diluted by the new money. They're better off than just investing in the new money, but they're also diluted by the new money in this math.
Yes, they are diluted by the new money in that their shares go into the pre-money for the new money. However, they're diluted by the new money only to the extent of their cap. If you use the discount, for instance, then they're really being treated like they're getting the same denominator in that case as the new money. So they're getting diluted, yes and no. They're getting diluted only if the cap applies. If the cap does not apply, then they're actually doing more of a post-money structure where their own shares go into the denominator in this case, if the discount were to apply.
Right, but I mean, if you look at the converted pre-money safes, that number 300 over 4 million is 7.5%, but they end up with 4.5% post.
Yeah, you're saying if this were, for instance, like a pre-money, so you'd have 3 divided by 4.3.
3 divided by 4.3, yes,
Yeah,
approximately 7.5%.
Not 4.3, sorry, 0.3 divided by 4, 3 divided by 43.
Yes, 3 divided by 43.
7%. Yeah. Whereas instead they end up, the pre-money safes end up holding 5% or 4.5%.
4.5%, yeah.
Because they are diluted by, and pre-money safes, by the way, are diluted by not only the new money, but also by the post-money safes. Whereas post-money safes are only diluted by the new money, because post-money safes by their terms pull in all the shares that are being issued to any convertible instrument. So they're not, and that's the reason this came about, by the way, is that, you know, investors saw companies doing, they'd put, you know, 500 or a million into a safe, thinking that was a bridge to a seed or an A, but instead find out 2 years later, or hopefully not find out by surprise, maybe, you know, find out over time as the company keeps on issuing 2 or 3 additional rounds of safes at higher and higher valuations. If those are all pre-money safes, then someone who puts in, you know, someone who puts in money at the first safe or someone who puts money at the last safe, everyone's getting diluted. You're getting diluted by all the other notes. So as a note holder, you might be unhappily surprised to find that out when the company finally converts, that you're not part of a 500K note group, but a part of a 5 billion note group.
Right. And in terms of market terms, what are you overwhelmingly seeing? You mentioned at the front of the call that the post-money stuff hasn't really taken off. So what are you mostly seeing in terms of safes and convertible notes?
I still see a lot of people, especially if you're talking about like I have some consumer product companies where you have high net worth individuals, they're almost always still in notes, like traditional pre-money cap notes. The investors in those cases barely know what a safe is. When you're talking about, you know, investors from Silicon Valley, they're starting to use a post-money safe in that case. And Morpheus, by the way, hates safes, for instance, but they like the post-money concept. So before this was even a thing, we had already started, you know, pulling in terms to the conversion calculations to make sure that we weren't diluted by additional surprise rounds. So it wasn't called a post-money note, but it more or less is a post-money note in those ways. So I'm still seeing pre-money safes more often than post, but I've seen a couple of post-money safes in the last 6 months, maybe. And for the company, by the way, it's usually better to have a pre-money structure. The post-money safe, in most cases, if you're a company that's going to do a lot of notes, the post-money safe insulates those investors from getting diluted by later notes. So
right, and it's just pushing down the founders.
Yeah. I mean, it does provide certainty. If the cap ends up applying, the whole point, and there's like a 30-page primer from YC on the math behind this and why it's a good thing, but the idea is if the cap ends up applying versus a discount, then all the parties have a great understanding of what the dilution will be from that safe, which is really valuable, right? It's just that if you plan on issuing more than one, it might not be the best route as a company to do that, because that means you as the founders are bearing the dilution versus the really safe, for instance.
So two comments, Caroline. So you said that the Y Combinator site doesn't even have the pre-money safe anymore. Is that because from a market perspective, they're saying do post-money safes today?
I think that's YC saying this is what people should be using. And also YC uses it for their own investments. So it's a bit self-serving in some respects, right? Like they use that for their own investments. So I don't know why they pulled it. But you know, we still have it on our system. I still have copies. I think Silk, for instance, used the pre-money safe before it became unavailable. So I don't think that's really, I think it's Y Combinator taking a position saying this is what we think investors should be using, and companies too. But
right. And the other comment I wanted to make to the group generally was, well, my experience is exactly the same as yours, which is if there are non-Silicon Valley or non-sophisticated investors in an early stage transaction, they almost always start with convertible notes because that's what they know. And convertible notes are not, if we're representing the company, convertible notes are not good. So everybody should understand that just because the transaction presented to you that way in the first instance, we should always be pushing back and trying to move that to a safe, even if it means we have to explain to the investors what that means and why it's being done that way and try to convert it. You may not always prevail in that argument, but you know, just because somebody likes a tech company and they're a real estate investor and they want a convertible note in, doesn't mean we should follow that path.
right, although you can, and someone said I'm getting quiet. Can you guys hear me okay?
You're all right.
Okay. I've had to change my audio settings. You can also, by the way, the reason notes are worse for the company is because they become due and payable at some point.
Exactly.
So you can get really close to a safe structure by simply giving a note a really long maturity, like 3 years or something, right? By that time, you should know if it's going to be payable or you're going to do a new round. So it is true that safes are better for the company, but you can get pretty close to mimicking that structure with a very low interest rate and a long maturity.
You can, but your crystal ball is no more clear than mine or anybody else's. And the problem is that I've seen lots of companies that go sideways for 3 years and ultimately do great, but then all of a sudden you're dealing with a maturity date, and you got to go back and negotiate with those note holders and explain to them why you're doing fine, but you need relief from the maturity date.
Yeah, I mean, yeah, it mitigates the possibility of that happening. It doesn't remove it, right? It could still happen in 3 years.
Right. Do we have, you sent this around to us all, obviously, but where is this form on the, on our form file? This should be in our startup forms for sure, in place of the old version of this that I used to have in there.
That doc was super helpful. Thank you, Caroline.
She froze. Unfortunate. So I would just add for the kind of junior mid-levels who haven't done a lot of cap table modeling, just because I've been in that position where I have no idea what I'm doing and I'm learning from scratch, and I feel like I've come a long way, but I'm certainly not a Caroline yet. But when you're doing these calculations, the kind of best thing to do is to kind of identify the formula that's in the document you're working off of and just start building out the pieces to that formula. And then you have the formula there to kind of put it together to make the calculation work. I just find that that's really the easiest thing to make it organized and sort of like set it apart and not so overwhelming. The other thing that, Caroline set this out in terms of safes, but a lot of us still work with notes that have a preferred and common structure. So that's a little bit different calculation. Again, it's just a formula. So if you just kind of write it out and then put it in the spreadsheet, like broken out, it will be a lot easier to break down and not so monumental as it looks kind of on the spreadsheet.
Yeah, that's a great point. And actually, we can just run through that quickly. I got booted off my internet. Sorry. Of course, that's happening now. We can just run through that since you're right. We do have that a few times. So if you look, for instance, at, let's see, at this one, say this instead of having, and by the way, we often see something called, I'm saying here it's seed 2 and seed 3, that's called shadow preferred. That means that you'll call it something else in the charter. You call it seed 2 or seed 3. That means a liquidation preference is going to be 38 cents a share, 41 cents a share, not 65 cents a share, so that the founders and common holders don't have liquidation preference overhang. Because if they're paying 38 cents and there's a 1x liquidation preference, they should not be getting a 65-cent liquidation preference on behalf of the company. Great for the investors if you can get it, right? But these days, I'd say shadow preferred is more and more common. But Kelly's right, there are some times we have, and I think our old form notes had this. I'm not sure if we still are using that much, but obviously it's still coming up and companies might be having financings. Hello Tech had this back in its Series A. And what you do in that case is the shares issuable is still the same. You should still be getting the same number of shares. So take this example, for instance, Series Seed 2. But if instead you're saying you'll get a mix of common and preferred, the idea is instead of saying seed 1, seed 2, seed 3, you get just, everyone gets Series Seed, but to make sure that these investors who are paying less don't get liquidation preference in excess of the amount invested, they get whatever their extra shares on behalf of the discount are in common. And that means that you just say, what would they get? So 300K is their investment amount. What would they get if they invested 300K at this price? The new money price. You can do They get 461,538 shares. But they should be getting 774. So that means that this Series seed shares, and then all the excess shares are common shares. And that's it. It's just the total share count stays the same, but you just figure out what number of shares they would have gotten had they invested at the new money price, and then issue the balance as common.
And again, the market position that you're seeing, there's a question. Is the market position that you're seeing more of the shadow deal versus the common and preferred? Yeah.
In fact, when we had the House Canary deal, I think our notes at one point had the common preferred mix, and Gunderson and Cooley asked us to change the shadow preferred. It's definitely more common to see shadow preferred. It's helpful too, because you'll see they both solve the liquidation preference issue, but really shadow preferred doesn't create the weird scenario where you have a large number of investors who hold common stock, as opposed to having common stock held primarily by founders. Could be good or it could be bad, depending on, you know, what the composition of that group is. But depending on the discount, you could have a pretty large number of common shares going to investors, which kind of messes up the voting mechanics that everyone expects to take hold. But yeah, shadow preferred is definitely more common. It solves the liquidation preference overhang without creating any new issue.
Does it not create the separate class voting issue?
No, they're not treated as separate classes. So they're just series. So class is just preferred. It's not you still couldn't, for instance, you know, treat the seed 2 different from the seed 1 as far as take away rights from, give them only to seed 1 and not to seed 2. But that's never the intention, right? The intention is to treat them all as one anyway. So as long as you're not trying to segregate and treat differently, and keep them all the seed voting together, which is the same as you'd have if you issued everyone seed and the extra shares in common. So as long as you're not trying to discriminate against seed 1, seed 2, or seed 3, then it doesn't create an issue. And again, you shouldn't be, probably, because that's not the intention behind the structure.
Okay.
We had no separate like voting rights, for instance, for like mergers and things, right? They're series, not classes.
That's where I was going. Yeah.
But it can have an impact depending on what percentage the shadow's gonna have if they're converting into common and preferred. For example, they'll have less voting rights in the preferred bracket than they would if they converted into shadow preferred. I've also had a random deal where they were supposed to convert into shadow preferred, but the lead investor wanted them to convert into common and preferred because the lead investor wanted to hold the majority of the preferred so that they controlled it.
Yeah, that's true. If the discount or if the cap relative to the new pre-money is really quite disparate, then you could have, you know, a lot more shares being issued to the safe and note holders relative to the new money, and the lead probably should care about where that lands. You can also solve that with things like, and I know Kelly and I talked about that was a weird one. They have very specific desires in that case, but you can also solve that if you're on the investor side by things like specific vetoes, you know, a majority including the lead investor or something that get around voting rights issues. All right, I've got nothing else. Anything anyone wants to flip to?
That was super, super helpful, Caroline.
Thank you very much. That was really helpful.
Sure, I've managed to do it for a while, and my guess is that, my hope is that some of the associates will take a look. They're probably, I would imagine that you haven't just had 100% of everything click for you. So please, if you take a look at that and have questions after digesting it a bit, you know, it's the only way to learn these things really is to do them, right? You can practice the sample scenarios is really helpful. But if you play around with that spreadsheet in all of your infinite spare time and have questions, please don't hesitate to ask me. I'm always happy to nerd out about Excel.
And just to elaborate on that point and tie back to a central theme of Stubbs, Alderton, and Margulies, and this comment's directed mostly at the younger lawyers on this call, but When we say to you that you need to own everything you do, this is what we mean. You don't walk away from this call saying Caroline's the expert on cap tables. The next time you're involved in a transaction that has this analysis going on, you need to own it, and you need to learn this and take the time to go through and learn it. And Caroline will help you. But second and third and fourth time, you should be as expert as Caroline. Well, it's hard to be as expert as Caroline, but you should be as expert as you can be.
Yeah, not to say like so we will help you, but just for context, the way that, and I'm by no means an Excel whiz other than among lawyers, but the way that you get comfortable with these things is just, spending hours and look, if you talk with the partner about how much time it's taking for you to like plug through it, you're gonna spend like 5 hours sometimes plugging through a pro forma to figure out how to make everything work based on the term sheet. You have to just, go through and try a few things before you get something to click. And Scott's right, just make the effort to just practice and go through it. And then we'll be there to support you.
Okay, we'll end a little early and let you guys go get your lunch. Thanks, everyone.
Thanks.
Thanks, Caroline.
Thanks.
That's great.
Thanks, Caroline. That was very good.